So I realized this morning as I start this meeting with my buddy, Larry Goldberg, that between the two of us, Larry, we have over 100 years of running businesses and dealing internationally. What do you think about that?
Yeah, it actually had occurred to me that we're two old fogies, shooting the breeze together. I mean, it's got to stand for something, I guess.
And you have a lot of experience in the subcontinent, the African continent, in India, in the Asiatic world,
And in London.
and in London, right? And my experience is mostly the United States, but lots of experience in China, Japan, Taiwan, and a little bit in South America, Israel. Between us, we cover most of the world.
Yeah, we do. We do.
All right. So we've called this meeting this morning, normally on the first Saturday morning of the month after the employment reports. I cover what happens with Cathie Wood because she reports on Friday night after the employment numbers. So that's what we're going to do today. You and I are together this time. This is the first time I've had Larry on to help me with this. We're going to look at what Cathie said and just what she got right, what she got wrong. That's assuming that we can ever question Cathie. Well, of course we can. And anyway, so this is Randy Kirk. You have found the channel where we talk about Tesla and we talk about the overall market situation. And please hit like, please hit subscribe, notify, all the jazz. You know what to do. And follow Larry at Tesla Larry on Twitter. So Larry, was there a major takeaway? Was there something that you just, as you were finishing up with the conversation with Cathie last night, you went, this is important.
I think, it's as much what Cathie didn't say as what she did say. I mean, she's been very consistent, over this period of tightening, and like you, and to a large degree like me, believe that the tightening has been overdone. I believe we're in these shock waves from the pandemic, and they're getting smaller and smaller and smaller as we move along. And I think that's essentially what she's saying, though she doesn't put it into those many words. So, I found myself as much in alignment with her as I've ever been, and I found very little to say, hey, wait a minute, that's not a good take. So I would say that, yeah, we're, the lesson is the Fed is tightening too far. The money supply has plunged. Velocity is not increasing, it's actually reducing. If they don't take their foot off the brakes soon, and they didn't have the brakes on, last round, but if they don't take their foot off the brakes, we could well be in real trouble. We could hit a really bad moment. That was my takeaway. I don't know, what was yours?
Well, so I'm paying a ton of attention to the whole inflation thing. I think it's obviously what the market's paying attention to. They don't want the Fed to continue to tighten. And I think the market believes in general that inflation is done. I think they're voting that way, both in the stock market and the bond market. They're saying inflation is done. And so as I'm listening to Cathie, one of the things that hit me was last year, the May to June number went up a lot.
Yeah.
And this year, we've got the May to June number that probably went up, a little. All right. And that difference is going to make a big difference in the year over year when the CPI prints this Wednesday.
Right.
So I did notice that the street is predicting a 3% year over year for the core, and the headline and the core, both at around 3 to 3.5%, which I would think, if that's what it is, I got to believe that the Fed has to pay attention to that a little bit. That seems like we're really decelerating quickly. And it might come in lower than that. It might come in under 3.
I think we're going to see below 3. That's my own feeling, but I could be wrong.
Yes. So I use Larry. I think I may have mentioned this to you before. You know, we have talked, of course, about trueflation.
Yep.
And I've come up with this theory that trueflation is about 2 months ahead of the CPI.
Yeah.
And trueflation 2 months ago was sitting at about 3.5. I'm sorry, 0.35. So in other words, almost, no, I'm sorry, 3.5 year over year.
Yeah.
But within a week, it dropped to 3. It was decelerating like this at that point.
Yeah, it's a question of when the look back ends. That's really what it amounts to.
Right. So
shorter the look back, the more proximate that fall off is going to be.
Right. Now, on the other hand, and here's where I might be differing from Cathie, and this is a brand new theory of mine just this last week, but I saw it confirmed in an article this morning. We have had, as you talk about, we've had this rolling problem of the supply chain over the last 3 years, through COVID, after COVID, et cetera. Not shocking that we've had ups and downs in commodity prices based on all of that. And the commodity prices, in particular, oil, copper, and a few others, are really important in this inflation thing.
Right.
A lot of people don't look back and say, okay, what's happening to commodities? It starts there. So what this article is saying, and what I'm starting to wonder, is have we bottomed out on commodities after this rolling thing? And could we now start to begin to see some inflation that would be the normal inflation in a time when business is this strong?
You know, that's an interesting question. The waves that I'm talking about really are first order waves. I think the supply chain is second order waves. So the waves I'm talking about is really people's pockets. So we saw this massive rise of savings. I think in 1 month, it rose by 30%, some gigantic number that was just unheard of.
People were saving 33%. They were saving 33% of their money.
In one, it went from like the normal 3 to 4% to 33% in like the first 3 months of the pandemic. It's just unheard of historically. Yeah. And we've seen that number bounce around, and then everything else is second order effects.
Okay.
I believe money is the principal driver because our modern economies, governments have taken such initiatives in terms of the printing of money. In Rome, it took 300 years to actually, turn the silver into lead, maybe 500 years actually. In our modern economy, that can happen almost overnight.
Yeah.
And at the time of the Trump administration, they spent money. I mean, it was unbelievable. And when the pandemic was already over, we went from monetary stimulus to fiscal stimulus. Actually, we had both actually, but it never ended after the pandemic ended. So you had the shutdown, which terminated all supply, and then you had the pumping of cash and put huge amounts of cash into people's pockets with all the extreme, results.
And no way to spend it.
Well, the stock market. Everybody put their money into the stock market, pumped stocks through the roof, which was only going to end one way. Yeah. So you had first order effects, and then you had second order effects, and then there were many effects thereafter. So what I'm talking about, this sort of wave that's slowly damping, then I'm talking about all of these, including the money supply, both fiscal, and monetary, and then I'm talking about the the second order effects, which is the supply chain, which we tend to focus on. And then it's also people's attitudes of spend, which both drives this, but is also affected by that. So all of these shock waves, they have been shock waves, not gentle, the normal turn of events.
Right.
Which means that when we measure now and use indices to measure, we're measuring using a norm that, was established ever since Bretton Woods, but which is completely turned upside down, or not even turned upside down, which is completely thrown out of the window when you get these gigantic excursions. So it's very hard to measure with history as our guideline.
And we have never had a world, never. This is a first time ever in it's never happened before with this old of a population. Never
Yes.
in history. We've never had a chance to see what having people, the average age being 40 years. I mean, we were 28, we were under 30 when you and I were growing up. And now we're over or right around 40 as the average age. This dramatically impacts how people spend their money.
Yeah, help me here. Are you talking US numbers or are you talking global numbers?
I haven't paid any attention to the global numbers, but I'm guessing the global numbers could be higher than the US numbers.
Well, it depends where. I think in Africa, they're younger.
Yeah, right, of course.
But in China, I think they may even be older and growing much older. They certainly are in Japan.
Right.
And we're talking about massive markets. And then there's Europe. So it would be interesting to see what the average age is globally, but more importantly, what the average age is in the wealthy world and what the average age is in the third and fourth worlds.
Right.
By spending power, I'm assuming that the wealthy world is really going to dominate the trends. So I think your point is extremely valid, but that's a kind of a longer arc.
But it's a long arc, but we basically have had this 4 or 5 years where we've had all this craziness, where I think we may have taken our eye, and now I've said this before on my channel, and I'm going to say it again, and Larry, you can disagree with me. I am a demographer. I have been a demographer for 50 years. I love to watch the demographic numbers and make predictions with regard to the future based on what is happening to population groups in terms of their age, in terms of what those ages are doing, and even in terms of the characteristics of these generations, because they are different. And so a 4 or 5 year period in demography is substantial.
Yes.
And the other thing that this group is doing, what we're seeing right now, is the beginning of the largest wealth transfer in history, where old guys like you and me, we're building wealth right now. You're still working, I'm still working, we still have income. You and I have agreed it's basically we're making income that's just going to be passed down to our kids.
Right.
And so that's happening. We're not alone. I have so many of my friends that are in the same boat. Yeah. And I've already made some distributions to my family. So that wealth transfer is happening. It's going to get bigger and bigger. We have no idea what happens to the economy with that kind of wealth transfer in such a short period of time.
That's true. That's true. One of the impacts of the wealth that we have earned is the behavior of our children. So that wealth transfer happens over our lifetime, because remember, our struggle when we were growing up was a lot less than our parents' struggle. I mean, my parents grew up in the Depression. So ours was a lot less, but our children and their children, I mean, struggle is not in their lexicon.
Yes, that's true.
And so in a way, that wealth transfer has been taking place over the last 30 years. And I don't think the results have been very positive myself, but we've had extraordinary growth in the economy in these 30 years, 40 years. The 70s were a big downer because of the excess cash being printed and the excess expenditures. I think, I keep thinking back to the 20s because there was this terrible flu pandemic in 1918, 1919, with echoes, small echoes in the 20s, and we saw this massive government expenditure, nothing like we had here, but certainly quite a lot of offsetting expenditure and these were fiscal, not monetary expenditures, because they didn't have the monetary tools of those days. The only monetary tool they had was, Morgan. JP Morgan actually put his hand in his pocket and helped his fellow banks, famously. And I went to his drawing room, his study, where he sat the bankers down, locked the door, and said, now this is who's going to fail and this is who's going to get money, and so on and so on. It was a very dramatic moment that led ultimately to the founding of the Reserve Bank, or was it actually founded slightly before? No, it led ultimately to the founding of the Reserve Bank because they realized they had to do something. Anyway, my point is the 1920 failure, which was a huge bust, was a direct result of exactly what we're going through now. And that's why I did expect a real dramatic
recession
moment,
yes,
as a result of this. And we're not seeing it. And whether we are going to see it or not, I don't know. But anyway, you're right. I mean, we're aging out. We'll pass. Our children will take over. It will be, this transfer of wealth will finalize, will come to its, end point, and will be quite a lot more dramatic than it has been. Although I think I've made the point that our children have really grown up already with that umbrella of wealth over them. So, and the results are not that great, by the way. Yeah.
So Cathie's other point, which is so on the one hand, we have this wealth transfer, and when you have that much more cash coming into the system, typically you could say that would be chasing fewer goods, or more cash, the same amount of goods. That would be inflationary. Cathie, of course, says we're going into a deflationary time, and it's a good deflation because it's and she continues to talk about that last night. That's her main theme. And it's a good deflation because it's coming as a result of technology lowering the costs of things. Now, I've been in the bicycle industry my whole life, and in the bicycle business, you could buy a nice 10-speed, 70 years ago for around $150. Now you can walk into any bike shop in America and buy a really amazing bike that's way better than that 10-speed for under $500, even though inflation would be at maybe 12 times, not 3 times. So there's a lot of technology, televisions, et cetera, that are almost free. Information is free. Phone calls are free, stuff that used to cost a lot in either time or energy or money. And what we're seeing now, and I think what Cathie is primarily referring to right at the minute, and I'm wondering what you think about this, is that the ChatGPT moment is not going to take 3 or 4 years to move through the economy. It is moving through the economy now. There are already Microsoft and others have actually made statements about the cuts in their overhead and the cuts in their costs months after this ChatGPT thing has hit. What are your thoughts in terms of the impact of this short term, medium term?
Yeah, I don't want to deal specifically with ChatGPT because I have a whole complex of thoughts around that. But I want to say that we have seen this collapse of cost generally, and AI has definitely got some impact, but in general, automation is the deus ex machina of this collapse in cost. I mean, you only have to look at Elon's, space business. I mean, he's taken what used to cost $300 and $400 million and collapsed that to $60 million. And he's on his way to collapsing it to $10 million and maybe $2 million. I wish he'd get involved in a few other industries but the point is, the moving of electrons has become almost zero, and the cost of energy is going to collapse to close to zero, very close to zero. And we see that coming at an incredible rate. You know, we could have postulated it out 100 years, 10 years ago, 50 years, 5 years ago. Now we're talking in the 10-year, 15-year cycle. So there's no doubt that we're seeing a deflation of the cost of moving molecules at an incredible rate. You know, we heard yesterday that the bots are already working in, you know, fairly significant roles in the Tesla Fremont factory.
Optimus bots, yes.
Yeah, the Optimus bot is already working, and there, you know, quite a few. It's guessed at 100. I think there may be a little bit of exaggeration on those edges, but there's no doubt that it's coming, and it's happening at an incredible rate. So that is dramatically deflationary. There's no doubt about it, and the race is on as to whether governments can inflate faster than technology can deflate. It's an interesting question, you know, and I mean, government has become so dysfunctional. The greater their role in our lives, the more dysfunctional they tend to become. And, you know, you only have to look at, you know, some of these governments like Russia. And the interesting thing is, China has had a centralized government, and yet they managed to more than muddle through. You know, they show this powerful. Anyway, that's a separate subject. Underlying it all is, I couldn't agree with Cathie more. Sometimes I disagree with her investment strategy, and sometimes I think the shares she buys is crazy. The shares are crazy, some of the shares.
Yes.
But in general, I agree with the postulate.
So I did an analysis a couple of years ago, Larry, maybe be interested in this, is that we're spending a fraction of what we used to spend of our household income on clothing, a fraction of what we used to spend on food, about half of what we used to spend on transportation. It turns out that we're spending, our percentage of household expense on cars is fairly close to the same as we were spending in the 50s, 60s. That's right. But we have 2 cars instead of 1, and we travel twice as far with those cars. So we're getting double the value, if you will, out of the transportation section. We're spending less. Obviously, you're spending nothing on information, spending nothing on phones. So we've had this collapse we've had a dramatic decrease in most of the spending categories that we have in our lives, except for one. And the one that's gone up a lot has been housing. So my theory out of that, Larry, is that as we lower the cost of food even more, which I think will happen, as we lower the cost of energy and get that one, we don't have the fuel bills to pay, we're going to be increasing our personal wealth. Now we can put that in the stock market, we put that in bonds, we can put it in a savings account. But I think what we end up doing is putting it in housing. I think it creates the, what do you want to call it? These amount of demand, dollars available for the bidding war for the available housing goes up, because you don't have it to spend in the rest of your budget. So you can say, oh, I can spend that much. I can, instead of spending 30% of my income for a mortgage, I can spend 35, or I can spend 40.
There's some countervailing forces to that. Population decline or relative population decline will offset that to a large degree. I think also the notion of the size of the house is changing. I think people are going to find themselves happier in smaller houses. It's just very, I see what you're saying, one thing that has not succumbed to deflation, though, is healthcare.
Yeah, so far.
I think healthcare has been a big offset to increase in spending power of the average person in the United States. It hasn't happened in many of the other countries as seriously as it's happened in the United States. So I think that one would have to balance that,
Percentage.
very pleasant sounding scenario with the issue of healthcare.
Now, on the flip side of that, Larry, that would be the number one category, I think, or maybe number two category for Cathie is healthcare, for Apple healthcare, for Microsoft healthcare. All of these major companies are now putting massive amounts of their R&D into how we do reduce the cost of healthcare.
No, you've just made a misstatement.
Oh, I did. Okay.
Not putting investment into reducing the cost of healthcare. They're putting investment into increasing their profitability. Because every product they come up with increases the cost of healthcare, does not reduce it.
Okay. All right.
Every major discovery of treatment and pharmaceutical discoveries and procedures and all of that has not reduced the cost of healthcare. It's increased the cost of healthcare.
But we have things like the DNA sequencing, et
But
cetera.
it hasn't reduced our cost.
Well, not so far. Yes, that's true. Yes.
No, it's actually all the major discoveries emerging from all of these new technologies end up costing the earth. The focus has been on these, relatively small impact diseases. When I say small, terrible diseases that impact a relatively small percentage of the population.
Right.
Because they can be charged for inordinate amounts of money.
Right.
We haven't seen a discovery that said, oh my God, that's going to reduce the cost of healthcare by X%. What we are doing is spending more and more money adding a few additional years to the lifespan, which is being offset by overeating and bad diet.
And bad other health, other life choices.
Yes. Yeah.
Right, let's switch over and take a quick look at some of Cathie's other stuff here before the audience believes that we didn't really care about Cathie's information. All right, so she mentions that the Fed is not mentioning, they have not talked at all about money supply. I think she was wrong on that. I believe that he did mention money supply in one sentence out of
wow, you look more closely than I did.
But money supply is down 5%.
Yeah.
And as she mentioned, and you just mentioned, the multiplier effect is actually dropping now. It had been going up, but now it's starting to drop.
Yeah.
So I've said multiple times that if you take the cash out of the system, that causes the worst kind of recessions. What do you think?
I agree with you 100%. I've been beating that drum for a while now. I'm very concerned about this collapse in the money supply. The collapse in the money supply is really indicative of the fact that the Fed has overplayed the hand, because they're dealing with the wave from, a year ago. When we talked about these waves, I think they're looking at the peak from a year ago. And everything has been dropping relative to that, or it looks like it's about to plunge relative to that. And what's going to happen is that you're going to get this, collapse of the money supply happening at about the same time as we hit this kind of dip, this trough in the wave. It's not good.
Yeah, so I saw an article the other day that says that the Fed has got a new report that they're doing that comes out once a month. So they've seen this report. And this report says that 1/3 of all companies are now under stress. 1/3. Now, I don't know if they're talking about mom and pops and the local retailer down the street, or if they're just talking about, S&P, because it didn't say in the article, but their own reporting is showing that 1/3 of the companies are under stress. And obviously, part of the reason they're under stress is because they're paying 12% interest now, where they were paying 7%, just 2 years ago. They borrowed money during the go-go days when they could borrow at 7%, and that made sense for their businesses. But now the amount of money that they're paying in interest might be more than their profits. So now, and then there's an issue of whether they can go back and refinance that money. They go back to the same bank, this regional bank that's also under stress, and they say, "What are you talking about? At 12%, you're dead." So this is where that company then sits there with the inability to refinance their loan, or at least at the same levels. They're losing money, or at least not making that much money. They're starting to lay people off because of it. And then maybe they can't pay their bills. They can't pay their suppliers, and then that ripples through the whole system. This is the issue that I've seen before, and it can be solved fairly rapidly by dropping the cost of money. It can be also helped a little bit by putting a little bit more money in the system rather than taking it out.
Yeah, so the observations you just made are the direct impact. They are the first order effects of money of the tightening by the Reserve Bank. This is what the Reserve Bank does. This is the outcome of what the Reserve Bank does, and they're the first order effects, and then everything ripples down from there. And it's not, it's going to take a while for what they do to hit. I don't think we've seen the bad days yet. I think they're still to come. And I think the drop in the money supply is really, a terrible sign. It's a very serious sign. I mean, when you talk about dropping the money supply by 2 or 3 or so percent, that's generally quite serious. And during the 10 years we had between 2008 and 15 years in 2023, we allowed the money supply to go through the roof. But fortunately, the velocity of money, just came down to almost zero. And so the net effect was not bad, because really it's all about the money, the velocity of money times the money supply. Well, the velocity of money has been creeping up and up and up and up. And the money supply has gone up like that. And, the end was, gone down like that. And so the outcome is going to be pretty serious. The velocity of money crept up in that first year after the pandemic, and it's just not budging now. So that collapse in the money supply is going to control, and I don't like it one bit.
Well, and Cathie points out that the velocity issue right now has a tremendous amount to do with the fact that you got risk-off money, zero risk money at 5%, 5.5% on 10 years. And so why wouldn't you put your money, or at least, I mean, I'm a risk on kind of guy, but I am old. So the vast majority of our liquid assets, so to speak, are in treasuries and things of that nature. I have a fairly nice position in Tesla, but the vast majority is in these 5.5%. Why wouldn't I be taking advantage of that? And that has no velocity.
Exactly. My investment philosophy has always been 10% of my liquid assets in the market and very high risk stocks, 90% in treasuries, or in the safest asset I can find. So these are very good times for me. I couldn't wish for a better time. But and it hasn't always been 90-10, because I ride my winners.
Yeah.
And so, some of my winners, I mean, the two amazing stocks I've had, although I've had several other very good ones, but the two amazing stocks I had was Amazon from 1999 to I think 2020, and Tesla.
Mhm.
Those were the two big ones, although, some of the others were not bad, but and so it took those ratios off, although I dropped my Tesla down to, and I sold the businesses along the line, and anyway, it doesn't matter. The point is, treasuries are really a great investment when you want them to balance your very, 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 very adventurous spirit.
Yes, yes, yes. So she points out that the GDP was revised up to 2.8% year over year, which is really decent. I mean, that's like almost perfect. I mean, that's where you really want it to be.
Yeah.
And that, but she says at the same time, here's a little one that I was not aware of. First time I've ever heard about this. The GDI, the gross domestic
It's the
income.
income.
I
Yeah.
didn't know about this report. She says gross domestic income in that same year over year number was down 0.8%.
Yeah.
What did you make of that?
Yeah, it was a surprise to me. Normally those track,
Yeah, yeah.
So it was a big surprise to me. It was the first I'd actually heard of that. And it's kind of an indicator of this imbalance that we're facing. I mean, people aren't working. And people aren't working. Somebody says to me that they're aging out. I don't think the imbalance is anything like as the level at which we have the unemployment is measured by those who are seeking work, who the government deems are seeking work. That's not the true unemployment. The true unemployment is the difference between the total number of people employed and the total number of people who can be employed. That's really the measure that has real impact on the real economy.
Yeah, I did see a statistic after you mentioned that in our program the other day, Larry. I just ran across a headline, and so I checked it out. And the good news, offsetting that just a little bit, is that the main years of employment, I forget what they used, 18 to 50 or something like that, I can't remember, that was showing pretty good strength. It really was the 50 and up group that was.
But that's a very large proportion, an outsized proportion of our
Population.
total population right now.
Yeah. And
So
those
you
people are
would
retiring
think,
early, yeah.
Yeah, you would think the 50 and under would be pretty good to offset what, but everybody's working longer now. And you know what? You know why? Because it's not that interesting to be retired, quote unquote retired. Some people prefer to work than to pursue, outside interests.
Yeah.
I do.
Yeah, I think there's an underreporting also in terms of the retired folks, the so-called retired, in terms of their home employment. I might be considered unemployed because everything I do is on the computer in my home, and I don't know how folks would consider that, but the income is very substantial. But I might at my age, and given it is all on the computer in my home, I might be looked at as retired.
You are looked at as retired, even though you're actually declaring income. You're looked at as retired.
Yeah.
Why? Because you're not paying Social Security. You're not paying. I mean, by all accounts, you're retired.
Right.
But so many of us are counted as retired, and yet we're gainfully pursuing, some sort of industrious activity.
So Larry, a lot of people have talked about a rolling recession. Cathie brought that up a little bit. She says, okay, some sectors are doing well, some sectors not so well. One that we care about a lot, autos, is apparently doing pretty well the first half and looking pretty good going into the second half with an aging fleet. And also housing, new housing starts are up, and new housing sales are up. I would say largely because that's the choice people have. If they want to buy a house, they have to buy a new one because the ones that are already existing are not for sale. What did you
That's
think?
right. So I miscalled the auto market. I thought there would be an auto market recession this year. I thought we'd caught up. We hadn't, not anywhere near. And there's a huge, there's a lot of people out to buy traditional ICE vehicles, not electric cars, because Tesla still, I mean, their numbers are up, the average prices are down, the margins are being compressed, which is interesting.
But Larry, but you have to take into consideration that Tesla is trying to add 700,000 Model Ys to the overall economy, world economy in 1 year. That's like, there's hardly any cars that sell 700,000 cars, period. And they're trying to add an additional 700,000 cars into the economy. So I don't look at that as a lack of demand on any level. That is a company that is in a recession being required to make some compromise in terms of their pricing or their incentives or whatever in order to move that much additional metal.
Right, but there's a pent-up demand for ICE vehicles, and there's not a pent-up demand for electric vehicles.
Yes.
I think
yes.
we're saying the same thing. You're just talking in relative terms to Tesla and their situation in terms of the growth of their sales. I mean, it would be difficult for any car company to add 700,000 of any model, whatever the powertrain is. So I get that, but I'm talking in relative terms from Tesla's historic demand. There's no doubt about it.
Sure. So we've got the CPI print coming up this week, Larry. We are obviously that's all the market is going to be thinking about. I mean, we've got every Fed guy, every single Fed president and governor and the chairman and everybody else speaking next week. So every day is a landmine. Every day those guys just have to slip on one sentence and the market goes up or down. But the CPI and the PPI prints on Wednesday and Thursday are probably going to control everything. You and I are both saying that we expect it to be better than the streets, at least equal to, maybe better than what the street is anticipating. What happens if it's 3% or less?
Well, if it's 3% or less, I think they've already made up their minds to increase and will and find whatever excuse they need. I mean, you can look at the figure, and then you can look behind the figure, and you can look into the figure, and you can make whatever argument you wish. They have made up their minds that there's going to quarter point increase, and it's going to happen. Now, if the print is 4 or more, oh boy. Oh boy. But if the print is 3, as we expect, there will be a quarter point increase without doubt. The extent towards which it is leaning down or is surprised down, well, they'll talk about this is about it unless we see and the extent to which it's a little bit up and trending up, it's, well, quarter point now, we're hoping it may be the end, but it probably isn't the end. And these are controlling, and they're going to have an impact on the market one way or the other, and quite significant percentages.
So Goolsbee, the latest addition to the Fed, was out speaking, I think, yesterday afternoon.
But he doesn't have a vote right now.
Oh, he doesn't have a vote yet?
I don't think so.
Okay. But
we'd have to look that up, but I think Goolsbee doesn't vote this round.
So he was out speaking, though, yesterday, and he says he was kind of, well, I don't want to say dovish, but he was at least saying he thinks that the Fed will pull off a non-recessionary soft landing. Might get a little rough towards the end of the year, beginning of next year, but that he thinks they'll pull it off. So does that hint that when he does have the vote that he might be more dovish than the rest?
Yeah, Goolsbee, as I recall it, has always been relatively dovish. I don't think he's ever been as hawkish as our current governor. but yeah, I don't think he has the vote, and I think I think he has a lot of sway. You know, he's highly respected. I think he'll have sway with his peers. But you know, this governor has shown enormous power to control the voice of the Fed.
Mm-hmm.
And the fact that Goolsby's coming out and saying this indicates to me that whether he cleared it or not, I think he must have the wink or the nod of the governor. That's just supposition on my part.
The good news is that the polling of the economists last week said that these economists, I don't know exactly who they use for this poll, are down around 22% now, believing that there will be another 25 basis point hike in September. I thought that was amazing. I thought that was quite compelling.
Yeah, and you know, that's the sentiment on the street. So as long as it comes in soft, as long as it doesn't come in hot, as long as it comes in soft, I think the sentiment will prevail. I think that the governor will be prevailed upon by the sentiment. But if not, he's gonna put a kibosh on everybody.
So, and then of course, we have PPI on Thursday. And while nobody pays as much, I pay way more attention to PPI than I do CPI. Again, I'm a manufacturer. You own businesses way bigger than my business. But as an owner, I'm way more interested in what guys are paying for stuff now, because that's what's going to be hitting in a couple of months. And so that's a leading indicator. The PPI has been quite low. It's been indicating inflation's completely under control. Do you think people are suggesting it'll still be under control this month? What do you think?
Yeah, I don't see what would have pushed it up. Wages possibly. Does wages enter the P? Yes, it does. So it could have an impact.
Wages.
But you know, so many costs have come down in the commodity space, and transport. Transport is a big factor in PPI. So I think I don't think that's the threat. You know, you say one thing and then you complete.
Of course.
This is it's a tough gig you've got here talking about the economy.
Well, and Larry, I'm hoping people stay with us, because I really wanted to talk with you a little bit about philosophy before we end today. So I watch people that say it's all about the macro, and that they make their investment decisions heavily upon the macro. Then I watched Gary Black come on the other day, who I have a tremendous amount of respect for, but on the Tesla bulls the other day, he's saying, look, the Tesla fall from 400 to 100 was all about the misses, the Tesla misses in the fourth quarter and the first quarter, but for those misses, and of course he parenthetically talked about the Twitter overhang and Elon selling shares and whatnot, but he gave no credence to the macro at all. Now I'll give you mine first and you can follow. I think that in the Tesla example, I think the macro was more than half of it, maybe 65% of it. I watched the macro like a hawk. All of the years that I was dealing internationally as well as domestically, I was always, my people around me wondered, how come you read the newspaper and US News and Time and why are you reading it? Well, because I want to know what's happening in the macro. I want to be able to predict what's happening next month and next year. So I just totally, unless Gary just misspoke that day, I think the macro is number one. Then you can go into the fundamentals of the company and take a look at what the fundamentals are looking like and make some predictions and projections based on that. And then also how those fundamentals might be affected by the macro. And then finally, I take maybe 10% of my look is the technicals, and seeing, because technicals, I believe technicals are self-fulfilling. It doesn't matter whether they're true or not. They're true because some people believe they're true. What do you think?
Yeah, so I couldn't agree more on the issue of macros controlling. I think there are some issues with, Elon's drama. He is a drama king. There's no doubt about it. He just generates it as he moves along. And it's his personality, and he's not going to change. I mean, we lived those years of the 420, and we lived those years of all of that stuff. And if you can't stand the heat, get out of the kitchen. If you don't like Elon, don't invest in Elon. That's it. Don't mess with the basic elements of this thing. But I have to agree with you that macro is controlling. So the fall to 100 seems more than excessive. It's just, it had to be driven down by immense shorting by, very big money. I think those guys got burnt. I don't know how many times short sellers have been burnt in this with this counter, and they just keep coming back. It is amazing to me, the religious zealotry with which they approach us. But yeah, I didn't get the same impression from Gary. I listened to that piece. I don't think I listened to it live, but I did listen to it. And if he said that, I think he misspoke, because I think that he would be the first to acknowledge that macro is very important. But what percentage is macro? What percentage is sentiment? Gosh, that's a really, really tough call. I mean, you'd think that if sentiment had anything to do with it, the stock would have gone down dramatically last week with the launch of Meta's Twitter killer.
Yeah.
If sentiment had anything to do with it, you'd think that the Zach Elon fight would have dropped the market by some huge amount. But none of it mattered. None of it had any impact, and it didn't seem to matter. So your thesis appears to be very accurate. Now, we have earnings on the 19th. Fasten your seatbelts. It's going to be rocky. Whatever happens, it's going to be rocky after that, because that's historically what's done. Everybody's closing out their positions or opening new positions, all on options, all of which have huge impacts on the stock.
Especially on Tesla. It's the number one option traded company.
So that has more to do with the stock than sentiment, not as much to do as macro. I think it's a second order effect to macro and to sentiment. No, it's actually a first order effect. I think this is how the stock is really controlled, is through the option buying.
Yeah, I have to admit to being a real neophyte when it comes to options. I have learned how to do one thing, and that's leaps. But I have not really dug in to be able to go on a daily basis and start looking at where sentiment is on puts and calls with regard to the stock market in general, or with regard to Tesla. I guess I rely on the technical charts to kind of give me a reading of what is happening under that hood. But I at some point, maybe I need to really go deep. I'm not sure. What do you think?
Well, options are mathematical. You can do the math on options down to 2 decimal places as to, where they are in terms of the velocity of their trade and the margin versus, you can do some very accurate analysis. What you can't do is tell what direction they'll end up being, what will actually happen, but you can tell from the math what will happen to you if something like that happens.
Right.
So you can calculate pretty accurately the outcome. But because the outcomes are so leveraged, particularly the shorter the term, the more the leverage, although leverage does exist from a time perspective on leaps, you know, those leverages can have huge swings, and they can impact the underlying stock, because whatever you do in the option, that has to be covered by the option maker, the guy who actually creates the option.
Sure.
So, you know, you're buying stock, or you're causing stock to be bought, or you're causing stock to be sold.
Yeah.
So, I mean, it's a very dangerous game. Wow. You can calculate very accurately how dangerous it is, though.
Yeah, so this is not investment advice. Larry and I are not investment advisors, but in general, my experience of almost as many years as Larry, we won't talk about how close. See, Larry, you give away your age. Mine is on my profile on Twitter, but I'm not going to say it out loud here because I get to hide it a little bit. My parents were genetically mutated in terms of how they aged and passed it along to me. So anyway, I'm not going to talk about it, but we're awfully close in age. And our 100+ years of experience of playing the markets and owning businesses and trading and doing stuff internationally, we've come to the same conclusion. Look at the macro first, then look at the fundamentals of the company that you're thinking to invest in. And somewhere along the line, you probably want to take into consideration the technicals, at least know where the likely points of tops and bottoms are, so you don't buy stupidly. Stephen Mark Ryan, a guy I have a tremendous amount of respect for, says, just keep buying. So have the conviction in that stock that you love, or the 2 or 3 stocks that you love, and just keep buying them over time until you lose your conviction and then get out. But anyway, that's not stock advice.
I couldn't agree with Stephen Mark Ryan more. If you have a conviction in the stock, accumulate over time and just keep that stock. You know, Warren Buffett tells us to, Stephen Mark Ryan tells us to. It all turns on what builds that conviction, and then just ride that winner. And this is not advice. This is just how I've been successful in the markets. And honestly, I can turn on a dime against a stock. I can sell it and just walk away, and without regret, even if it goes up after that. Once I lose conviction, that's it. You know, I'm done. And there are quite a few things that play into conviction, but I always do very careful analysis in the stock. And then I always check my analysis with the outcomes. And, you know, that helps me. But yeah, I mean, we can't give investment advice. We just don't have that experience. But, you know, our individual approach is really, you know, it's our experience and our ability to sustain risk is really controlling, I think, our individual philosophies.
Larry, I could not leave without commenting on what you just said, because you said something that I believe is so critical, and that many investors, maybe our crowd, maybe the folks listening right now, are way different than this. I think I should really do an entire video on this. Maybe you and I could do it together. The difference between making money in the stock market and not making money in the stock market will almost always come down to your information advantage. To the extent that a person jumps into a stock based on somebody saying, hey, you ought to buy this stock, compared to somebody who, in my particular case, has written 2 books on the founder and the company, and now has a YouTube channel with 400 YouTubes up about the founder and the company. My knowledge about Tesla is what gives me the conviction that I have, and gives me a massive information advantage over the average investor, even over the Wall Street investors by far, because I see them making ridiculous statements all the time that are just not true, completely wrong. When you have an information advantage over somebody else in a market, you are always going to, over time, you will definitely always win.
Absolutely. I couldn't agree more. Could not agree more.
All right. Well, on that great note, a point of agreement, we will call this to a close. Larry, Always fantastic to have you on board. If you like having Larry on board, well, you've already told me you do. Larry's the only one that you say you actually love him. So you might like, Brian White, but you love Larry. So there's a difference there, Larry. So hit the like button, hit subscribe, hit notify. This afternoon, I will be doing a news wrap up from what's taken place since Friday up until this afternoon in terms of Tesla news. That'll be up later today. The rest of the weekend, I don't even know. I'm so far behind in my thinking. I know I have it down there somewhere what I'm going to do on Sunday. But anyway,
great Wall Street article on SpaceX and its dramatic lead in the space race.
Yes.
Its monopoly position in the space race.
That was the headline, monopoly. I saw that.
Yeah. Great article.
Great article. Absolutely. Okay. And then follow Larry at Tesla Larry on Twitter. And then follow me everywhere. You know where to look, especially Patreon. Thank you. So many people joining up this week on Patreon, because I am now putting up some unique, some information that will only be on Patreon, at least for the time, at least for weeks, maybe. And I'll be putting up a lot more unique information on Patreon. So check the information below to click that number, that URL. And right now you get 7 days free. So what the heck? What a deal. Huh, Larry? What a deal.
What a deal.
Thanks for being on board again, Larry. And
thanks, Randy.
to all of you out there, it's been great talking to you.
Bye.